So the fourth largest country in the world has just become a Bitcoin country. That's right. If you missed the announcement, on Friday at the Bitcoin Miami conference, a governor from Indonesia by the name of Ridwan Kamil came out and made this announcement.
We have the biggest reserve of renewable energy in the world. That's where the Bitcoin minings come to play. In the future, we could be the heaven for a Bitcoin investor.
Now, this announcement is huge because there are over 270 million people in Indonesia, making it more than 50 times larger than El Salvador, who of course was the first country to make Bitcoin legal tender in 2021. And they're not only big from a population standpoint. Indonesia is also the largest economic powerhouse in Southeast Asia, and they're the 16th largest economy in the entire world, which again makes them more than 50 times larger than El Salvador's economy.
To understand whether this announcement by Indonesia will open the floodgates of other nation states making Bitcoin legal tender, we need to understand why Indonesia has made this decision today in 2023. We can see that even before this announcement, Bitcoin adoption in Indonesia was huge, okay? This survey here found that Bitcoin adoption in Indonesia was 41%, which is the highest adoption rate in the world, okay? This study was titled The Global State of Crypto Report, and it found that 41% of Indonesians aged between 18 and 75 with an income of more than $14,000 per year owned some crypto assets. So this means people in Indonesia could be using stablecoins and Bitcoin and other shit coins. Why are Indonesians moving towards Bitcoin? Well, we can see here that 50 to 60% of Indonesians are actually unbanked. And let's also remember what made Nayib Bukele make Bitcoin legal tender in 2021, okay? Let's remember, it wasn't a top-down decision where he made his citizens use Bitcoin. Bitcoin was actually spreading from a grassroots level in 2019. I think Bitcoin Beach was a Bitcoin project that was actually created in 2019, and it was growing nicely. So governments respond to what the people want, okay? The people wanted Bitcoin in El Salvador because there was no banking infrastructure and the remittance payments are ridiculously high. Same story here in Singapore with 60% of the population unbanked. We can also see that judging by this study, Indonesia receives around $10 billion in remittance payments every single year. And considering they have such poor banking infrastructure in the country, Bitcoin fixes this, okay? We can also see here that remittance flows have grown exponentially, okay? Indonesia was only receiving $10 million from remittances in 1983, and in 2019, they're receiving 11,000 million, okay? That is an increase of well over 1,000%. That is enormous, and it shows the growing need of remittance payments for these poorer countries in Southeast Asia. This is causing governments in Southeast Asia to look for an alternative. We can see here from this headline that the US dollar is no longer king as the ASEAN adopts currency swaps. So this association of Southeast Asian countries includes countries such as Myanmar, Vietnam, the Philippines, Malaysia, Cambodia, Singapore, and of course Indonesia. And they are all fed up with the US dollar, and they want to actually increase their usage of local currencies to reduce reliance on the US dollar. I've highlighted this little quote here from the Indonesian president who said, "We must remember the sanctions imposed by the US on Russia." This is a recent article that just came out a couple of weeks ago. We can also see here that Indonesia continues its de-dollarization plan, and they are not the only country in Southeast Asia actively looking for a solution and an alternative to the US dollar. It is an enormous signpost of what is going on in Southeast Asia, okay? Indonesia has a population of 270 million people. So the fact that we have a government employee who is in the race to become the next president of Indonesia talking about Bitcoin favorably, it is a very big announcement, okay? I did want to note, yes, he did mention a few buzzwords in his presentation which set off little alarm bells in the back of my mind.
I fight corruption using artificial intelligence. I'm using blockchain technology for my coffee business. I'm using IoT to feed the fish, to feed the chicken.
So what does this mean? What should we take away from it? I believe that this is just another signpost that China and many of China's neighbors in Southeast Asia are secretly coming up with a Bitcoin plan to de-dollarize their economy. To find out which country is going to make Bitcoin legal tender next, we should look at some of the very interesting developments that has been occurring in Southeast Asia. We can see by this chart here that is tracking the top 10 countries around the world who have the highest Bitcoin adoption. 6 of those 10 countries emerge out of Southeast Asia itself. We can see that those countries include the Philippines, Thailand, India, Pakistan, and, to everybody's surprise, China. But there are also some other countries in Southeast Asia who have postured as if they're going to welcome Bitcoin into their country. We can see here the Kingdom of Bhutan recently got exposed for buying hundreds of millions of dollars of Bitcoin when the bankruptcy filings of Celsius and BlockFi were released. And what's really interesting about the Kingdom of Bhutan is when they were exposed for buying hundreds of millions of dollars of Bitcoin, they did not stop there. They actually doubled down on their decision. We can see here from this little tweet thread that I popped out this week that the Kingdom of Bhutan came out and said, yes, we've been buying Bitcoin since 2019, but we've also been mining Bitcoin since 2019. And this week, they announced a partnership with BitDeer, one of the world's largest Bitcoin miners around the world. And they said, we are going to invest another $500 million into Bitcoin mining. Kingdom of Bhutan is not the only country in Southeast Asia currently stacking Bitcoin. There is also another country that neighbors China. It's called Laos. So this country actually banned Bitcoin in 2018, but in 2021, they actually reversed their decision and said, look, we're going to engage into a Bitcoin mining pilot program as well as a Bitcoin trading pilot program. And we can see here that the country has an enormous amount of hydropower. So they're using that to mine Bitcoin. The government authorized 6 companies to actually start mining Bitcoin. And the government actually expected that they would make $260 million from the Bitcoin mining in 2022. And another country in Southeast Asia that has very high adoption of Bitcoin is the Philippines, okay? The Philippines is an enormous country. They've actually got a population of 110 million people, and they receive the 4th largest amount of remittance flows every single year, which is competing with countries much larger than them, such as China and India. And Philippines is very interesting because they also have some of the best demographics in the world, second behind Nigeria. But they also have enormously high Bitcoin adoption rates. So this little survey here, you can see that Nigeria was estimated to have 32% Bitcoin adoption. The Philippines had 20% Bitcoin adoption in 2020 from this survey, and adoption since then has only risen. Have a look at Hong Kong. They recently came out and announced that they want to become a crypto hub. That's their words. I think they should be focusing on Bitcoin. But this article here is very interesting because it shows Hong Kong's crypto ambitions with the quiet backing from Beijing. Let's remember, Hong Kong is a Chinese-controlled country, and Bitcoin mining in China is supposedly banned. So it's interesting that Chinese officials have been spotted at these Hong Kong Bitcoin events, and they're apparently okay with what Hong Kong is doing. And the plot thickens even further when you consider that China is still the world's 2nd largest Bitcoin miner despite banning Bitcoin in 2021. That stat really makes you ask the question, who is mining that Bitcoin in China?
Why have all of Chinese neighbors seemingly warmed up to Bitcoin? Okay, they've reversed their Bitcoin bans. They've been secretly buying Bitcoin for the past 3 years. And Southeast Asia has some of the highest Bitcoin adoption rates in the world.
We had some truth bombs flying from our favorite representative out of the 32nd district, not too far away from here, Congressman Brad Sherman. He of the Banking Oversight Committee dropped some truth bombs in Congress yesterday. He made a very strong point that
they'll accuse the U.S. government of making money out of thin air. Maybe we do, but we're the U.S. government.
Yeah, for the first time in years, Brad, you're right. It is completely immoral and completely stupid to think that humans should be using money that's printed out of thin air. If only there were a money that could not be printed out of thin air. If only there were one money that we could turn to that actually was fair, that was sound. Bitcoin, perhaps? Maybe Brad's coming around. Not that I care. All of these geriatrics are on their way out, and the Bitcoin generation is rising. And it's an orange wave, and there's nothing you can do to stop it. We're not selling! Sorry, just channeling my inner Max Kaiser there for a second. As my homie Nico Moran behind the camera here said, I refuse to use a money that another man can create for free. Fight on. Let's go Bitcoin.
Probably in one of the most important charts in global finance, which is global liquidity. We know that there's all sorts of nonsense that's going on. There's the debt limit crisis, there's inflation, there's the Fed's comments, there's interest rates, etc. But global liquidity seems to be driving a lot of asset market movement. And so what do you think is happening with this global liquidity right now?
Yeah, absolutely. And thanks for having me back. Always a pleasure to be with your audience, man. So I'll start by saying we think the debt limit is sort of ceiling, whatever you want to call it, crisis or lack thereof, is very much a sell the news event. And the reason we think it's a sell the news event is because the return of Uncle Sam, i.e. the federal U.S. government, back to international capital markets is likely to drain a significant amount of liquidity from the global financial system. So in this first chart we put up here, we show in the blue line the statutory debt limit as approved by Congress here in the U.S. That number is currently at $31.381 trillion. It's funny we say the word T, we throw the word T around like it's like it used to be a B. But anyway, so that number's at 31.38 trillion. We are at the red line shows the U.S. debt outstanding that is subject to that debt limit. And as you can see, the red line and blue line have had the same value for the better part of 2023. And so that's one reason why we've seen, such positive asset market performance in the first half of this year is because we have not had to compete with Uncle Sam in terms of all that liquidity, demand for all that liquidity. And secondarily, if you look at the black line there in this chart, we show the Treasury General Account balance, which has declined all the way from right around a little bit over $800 billion, a few months ago, all the way down to 61. Sorry, not a few months ago, a few quarters ago, all the way down to 61 billion. That has been a positive development for the global liquidity cycle, and has certainly been a supportive factor for why asset markets have been taking this kind of debt ceiling crisis, if you will, like it's not really much, like it's a walk in the park.
Explain what happens when all of a sudden there's an uptick in treasury bills, right? When the federal government starts issuing these things and we see this thing just tick up, what exactly do you expect to happen?
Yeah, so actually that's the second chart we show. So in the second chart, the title of the chart is a significant uptick in T-bill issuance would actually sterilize the pending rebuild of the Treasury General Account balance. So I'm sure most people know this, but for those of you who may be new to our ecosystem and how we think about the world, the Treasury General Account balance is one of the factors we use in our adjusted net liquidity model that we're trying to kind of contextualize the ebbs and flows of liquidity stemming from the interplay between the public and private sector. So the Treasury General Account balance, the best way to think about that is sort of the Treasury, the U.S. government, the federal government's checking account that it has on balance on the Fed's balance sheet. And so that number, when it goes down, it ultimately means the Treasury is taking money out of the Fed's balance sheet and putting it into the real economy, either, retiring debt vis-a-vis principal and interest payments, or they're using that money to spend on services, et cetera, in the economy. And so it's basically a net increase in liquidity when the line goes down. The line is about to go up and go up in a major way in the coming months. If you look at the most recent guidance that we got from the Treasury Borrowing Advisory Committee, suggesting that this red line could be at $600 billion by the end of September. So that basically be bouncing off zero. So you're talking about a significant increase in the amount of money that the Treasury is going to take from the private sector to refill its coffers on the Fed balance sheet. Now, you asked the question about T-bill issuance. One thing that could actually make that process a little bit less onerous for markets is the fact if the Treasury, if Janet Yellen, Secretary Yellen decides to issue a significant amount of T-bills, i.e. instead of notes and coupons, these are shorter-term Treasury debt securities that mature in less than a year. There's a lot of excess demand in that black line for those particular types of securities. There's about $2.3 trillion in the Treasury, around $2.3 trillion in the Fed's reverse repo facility balance. Now, this is going to get even more wonky and esoteric, but I'll just be quick. That's basically money market funds looking for T-bills, unable to find them, so they're parking that money on the Fed's balance sheet and earning the interest. They're earning right around 5.05% for that money. So there is excess demand for these securities, but she may choose not to issue T-bills, and there's a variety of reasons why we think that.
So when you look at these easing financial conditions, but inflation running hot, I think one, it begs the question, like, what actually is inflation right now, right? You look at trueflation, that's down around 3%. You look at the official CPI metric, that's like 4.9%. Then you have the question of, like, does that actually get incorporated into whether they're going to issue the T-bills or not? I think, as you point out in one of these charts, that Janet Yellen used to actually run the Fed. And so there's some thought process around monetary policy, along with this debt limit crisis and a depleting kind of balance for the Treasury. How do you see Janet Yellen kind of decision-making playing out here with quantitative easing or some sort of financial easing given inflation?
Yeah, that's a great question. So let's summarize that before we even unpack the inflation can. If Janet Yellen decides to issue a significant amount of T-bills on the other side of the debt ceiling, which, sometime around June 1st to June 15th or so is likely when we're going to have that thing moved, or at the bare minimum punted into the future, she can choose to replenish the coffers. And then also don't forget the government has a pretty significant budget deficit of around 7% of GDP that they also need to finance as well. If they issue a bunch of T-bills, they can drain the reverse repo facility balance down and tap into that excess liquidity and make that process somewhat smooth for asset markets. However, if they choose to issue a bunch of notes and coupons, these are interest-bearing securities that mature a year or more, up to 30 years currently, then that process is likely to be very onerous for asset markets, because we, the private sector, are going to have to come up with funds to support that debt issuance. We're going to have to sell stocks or sell other bonds or sell Bitcoin or something to capitalize the U.S. government. Maybe not on a one-for-one basis, but certainly that's kind of how it impacts the broader private sector. So going back to your question on inflation, we sort of have to put ourselves in Janet Yellen's seat to give a sense of why she might choose to go one down one door or into door B. And we hypothesize that because inflation is still running at right around 2 to 3x the Fed's price stability target, particularly when you look at these measures of underlying inflation on a 3-month annualized basis, that it doesn't make a lot of sense for her to support an easing of financial conditions, which would coincide with the flooding of the market with T-bills. And so in this chart here on slide 3, we show median CPI, trim mean CPI, median PCE inflation, trim mean PCE inflation, core PCE inflation, which is the Fed's preferred inflation mandate, and then super core PCE inflation. And all these numbers is at least 2 to 3x the Fed's price stability target on a 3-month annualized rate of change basis, which is super important because after you get past June, we're going to start to lose, the kind of the steepening of the base effects that has been driving, year over year in price time series down in terms of inflation. And we might actually start to see a bottoming process emerge in inflation time series on a year over year basis as we head into the back half of the year. So it's very unlikely, in our opinion, that Yellen is incentivized to do anything that would support, asset markets and S&P going up, et cetera, because ultimately what that just means is it's going to continue to fan the flames of inflation in the U.S. economy.
The yield curve throws another curveball in here. What do you think that does?
Yeah, so going back to this discussion on inflation, we don't think Yellen is sort of incentivized to be very kind to asset markets, in the months and quarters following this debt ceiling increase, because ultimately it means if she's being kind to asset markets, she's ultimately being very kind to the real economy, which would be very counter to the Fed's stated objective of slowing the economy, causing pain in the economy, so that we can get inflation back under control. The yield curve, this inversion in the yield curve, and it's a pretty significant inversion, one of the deepest inversions we've seen, going back to the early 80s. This deep inversion in the yield curve further disincentivizes her from flooding the market with T-bills, because again, T-bills, which are the shorter maturity treasuries that mature up to 1 year, these have the highest yields currently. Whereas if you look at notes and bonds, down there, kind of that's what this green line shows in this chart here on slide 4. The interest rate across the curve from bills to the left, all the way to the bonds and notes and bonds all the way to the right. And as you can see, she's sort of incentivized at this particular juncture to lock in lower coupons if you kind of, issue kind of in the belly of the curve, somewhere right around 3 to 10 years. And so the reality is, just from a budgeting management standpoint, because obviously the Treasury has to pay interest on all this debt, just from a budgeting management standpoint, it does not behoove her to concentrate a significant amount of issuance, which we think, according to our math, could easily be somewhere between $1 trillion and $1.4 trillion in the 2 quarters following the debt ceiling. Tons of issuance, a massive amount of issuance that we have to digest as from a market participant standpoint. If she concentrates that issuance at the top left of the chart right here on slide 4, then we're going to have a problem as it relates to the U.S. government's, kind of ballooning and burgeoning interest payments. So that's going to be another